So, good afternoon, everyone from everywhere you might be hearing me. And sincere apologies that we could not meet up yesterday. Uh, I told you that I sent a video to the platform and I told you to watch the video. I believe some of us will have watched it. Please, if you watch it, and then we'll just give us an overview of what impairment is all about. We are looking at still that standard IAS36 impairment. If you can just tell us, just raise your hand, tell us what you know about it. Give us the simple meaning. If you can hear me, please just give me a thumbs up so that we can move ahead from there still. You can hear me. Okay, thank you. So, Franca, you raise your hand. Go ahead. Give us an explanation. Or what exactly do you understand by the, or give us an overview of impairment all put together. Franca, go ahead. You have the floor.
Yes, yes, sir. Good afternoon. From what I watched yesterday, it was said that impairment occurs when the carrying amount of an asset is higher than the recoverable amount of the asset. So, and there were some key points that were greatly stressed on, like the meaning of recoverable amount, the meaning of fair value. Because when we want to derive recoverable amount, we're going to get the higher between the fair value or value in use. So from there, we're told that fair value is a price of an asset in an arm's length transaction. That is at the measurement date, the price of the asset at that particular date of sales. So, and then recoverable amount is what higher of fair value or value in use. And you, in that video, taught us the stages in accounting for impairment losses. That is the stages that we are going to, 3 stages that will pass through to determine whether there is loss of impairment or not, testing for it. First stage is to test if there is an indication for impairment, and those indications are both internal and external, which we'll mention later. And the second stage is to know if there is an indication, then we'll now calculate for the recoverable amount, which is the higher of fair value, less value in use. And then the third stage is to compare the carrying amount to the recoverable value, whichever is higher. So if there is indicator for impairment, the entity would now test for it. So these indicators, which could be external, is an unexpected decline in assets in the market value of that is when the market value of the asset unexpectedly reduce or drastically reduce, it shows that the asset has impaired. Another external indicator could be when assets are overvalued in the statement of financial position. That is when the company's net asset has the higher carrying value compared to the market value. So there are other external indicators in that videos, something like changes in technology, and then government policy, economic factor, and the rest of them. And then internal factor, you can have something like when the asset is damaged or obsolete. You use example like our phone. Like if I had, every one of us have cell phone. If I bought it 500,000 in 2025 and I want to put it to sale in 2026 and the screen is broken, I can't sell it again at 500,000, meaning that the asset has impaired, that my phone has impaired, the value has reduced. That is the layman's meaning of impairment, when the value is no longer how it was when the asset was purchased. Another internal indicator could be reduction in the useful life of the asset, or when there is a plan for the entity to discontinue or to restructure operation in that particular area. So you also talked about measurement of how to measure impairment, and you said that the simple understanding of measurement is the same as calculation. Hello?
I can hear you. Go ahead.
Hello? Okay, measurement first. So I calculate the carrying amount where applicable, and then you now calculate the recoverable amount. That is, they were also places that you mentioned, let me just say what I got, whether I got it rightly, I don't know, about the treatment. You said that when there is impairment, we'll write it off in the statement of financial position. That is, if it is at the first time. But when the asset was already impaired beforehand, and then when we are calculating the impairment and it's the second time, that it will be, that is, if there was already revaluation surplus, the impairment loss will be first recovered from the surplus that existed before it will now be written off again. I don't know whether I'm getting it right, but I think you stress so much in that particular aspect to know whether it is first time impairment or it is impairment that is occurring for the second time. There were illustrations in that video. Some of them impairment with under CGU and impairment for single asset. The one that is for single asset is easier. That is where we write it off in the statement of financial position. But if it is group
Oh, we lost Franca.
it off like goodwill cannot accommodate it all, will not on pro rata basis allocate it to other intangible assets. I think that is the one I
Please,
can
everyone,
say now.
help me clap very well for Franca. She has done justice to it, and I'm so glad and happy that she can, I mean, delivers this so much. Look, that is everything that you need to know about impairment. That's everything you need to know. Okay, and I want to give Franca a 5 mark for what she has done. Please just claim it. I'm giving you 5 mark for what you have done. You have done justice to it. It's as simple as that.
Thank you,
Thank you
sir.
so much, Franca. I'm so impressed. Thank you so much. Okay, Nofisa, you are raising your hand. You want to add or what?
Thank you, sir.
You can mute your mic, Franca. Thank you. Uju, okay, go ahead. Okay. Let's just put down our hands and mute our mics. I think that is just a summary of everything that we are looking at when we're talking about impairment. You see, impairment is more or less like measuring the value that have been off an asset over a period of time. What I mean is this: it is important that whatever you are putting in your financial position, in terms of value of an asset, should be the current value of that asset. That being said, when we say impairment occurs when that value of the asset that you are carrying in your book is now higher than what you can, receive if you are to sell the asset as at today. So literally, when we say impairment simply means you have an asset today that you are carrying in your book at 300,000 naira. If that asset, if you are to sell it today, if you are to recover the amount of that asset today, if the recoverable amount is now, I mentioned 500 or so, I think so. If it's 500,000, and now the amount that you have to recover it now is 450,000, it simply means that the current amount of the asset is higher than the amount by which you can, receive to sell the asset as at today. That is also the simple meaning of impairment. So, when the current amount or the net book value of an asset is higher than the recoverable value, impairment is said to have occurred. And what is current amount? Current amount is the net book value of an asset at the current financial date. In other words, it is, the asset when you have deduct any of the accumulated depreciation over the years. So whatever you have as your book value is the current amount. And then the recoverable amount simply means the amount that you will receive if ordinarily you are to sell the asset, if you are to, dispose the asset now, or you are no longer using the asset, you want to sell it now. And what amount exactly are you going to even receive, to are you going to receive on the asset if you are going to dispose it? You are not disposing it. It's not that you are selling it, but you just want to be sure that, okay, if I'm going to let this asset go, how much can I receive if I'm to sell it as at today? That's what we call recoverable value. And so for you to measure that recoverable, that amount, you can use two methods. Number one, you can use the fair value method, and then number two, you can use the value in use method. That is how it is prescribed under IAS36. And what is fair value? Fair value simply means the market value, the market value of an asset at an arm's length transaction between market participants at a measurement date. In other words, it is the market that the amount you will receive if you are to sell the asset. Where there are no inducement, where there are no any other, what is they call it now? All these activities in the market, that may want to induce the price, as it were. All things being equal, there are no inducement. Everything is just less as fair. That is, it is free. Free entry, free exit is in the market. And a good example is, for instance, if you have a motor vehicle, you can openly go to these online stores like Gigi, Jumia, Konga, Temu, and the likes. Those are free market. And then you just Google Corolla 2024. How much is it? And they tell you it is 200,000 naira. You compare it with your prices are today. My own Corolla 2004. How much am I carrying in my book? I'm carrying at 250,000. It means that the carrying amount is higher than the fair value of the asset. So when we say fair value simply means the prevailing market price of the asset. That is the amount at which you can you can receive if you are to sell the asset at an arm's length transaction. That is a fair value. So understand also that when you are measuring fair value, you are going to less all the cost to sell. In other words, all the fee that are attached for you to sell the asset, because you are not selling it, so you will not attach all those fees to it. When we look at fair value IFRS 13, you will understand better. So where fair value simply means, that the amount itself less all the cost to sell. You understand? For instance, if you are to sell your motor vehicle now, definitely, the person I want to sell will say, you give me a commission. And the person I want to market will say, give me this one, that one. All of those ones are part of the cost to sell the asset. So all of them put together will have been summed up inside the amount that they are going to sell the asset. For instance, now, if you are going to give your car to someone to sell, the person that want to sell it will have added his own commission to it. If you put in the car down for 200,000, the person will have added maybe less than 20,000, and he will tell buyer it is 220,000. So that 20,000 extra, that is the commission to the person, we have to remove it to get the original cost. That's why we say fair value less cost to sell. That is number one. Then the value in use. Value in use is when you discount the cash flow. That is for instance, if they say value in use, if you are to continue to use the asset in a numbers of years to come, how much cash will you be able to generate? That's what we are talking about when we say future cash flow. So value in use is discounting the future cash flow from the continual use of an asset, into today's present value, discounting it. So if you are in an exam, or if you are seeing a live question, or if you are treating any question, once you see that they give you cash flow, they tell you that this asset is expected to generate 100,000 naira for the next 5 years at a discount rate of 10%. Just know that you are going to do what we call, you are going to discount those future cash flow to determine what we call the present value of the asset. And that is what we call value in use. So now, for you to determine your recoverable amount, it must be the higher of the fair value and the value in use. Anyone that is higher between the two. Let's assume, for instance, now, like I said, we'll go to practical fully. Let's assume, for instance, now, The value of a motor vehicle in our book as of today is 400,000 naira. 400,000 naira is the net book value of our asset, that's motor vehicle, for today. I'm just placing it, I'm not using PPE now. I'm bringing out an asset from PPE, that is motor vehicle now. And I said today the value is 500,000 naira. And then they give us the fair value, let's cost to say, of the asset to now be 450,000 naira. And we're also told that the value in use of that asset as of today is 460 naira. Class, which one will be our recoverable value? Just raise your hand. What I've said is the net book value of an asset is 500,000 naira. The value in use is 460,000 naira. And then the fair value, let's cost to say, is 450 naira. What will be our recoverable value? Michael, go ahead.
It's 15 naira. 50.
You said?
15 naira, 15. 15
Thank you so
naira.
much. Thank you. Idris Ayomide, go ahead. Ayomide,
Good afternoon, sir.
good
The
afternoon.
recoverable value is 460,000 naira.
Please let me clap for her. 460,000 naira will be the recoverable value. Why is it 460,000 naira? Idris, you are still going to answer.
Because you said the recoverable
Just
value
say it
is the
now.
higher between the value in use and the fair value less cost of disposal.
Thank you so much. So, anyone that is higher
I
between the
said
two become.
the
You are right. You are right. Go ahead. Thank you. So it is the higher of the two that becomes your recoverable value. Please, you can mute your mic. You can bring down your hands also. Thank you so much. So that is that for that. Now, you see, when you are to measure or determine an impairment, there are three stages. The first stage is to test for the indication. Look out for the indication of impairment. Very, very important. And then the indicators can be divided into external and internal indicators. If you have not watched that video, please go and watch the video. If you have not bought the material, go and buy the material. First of all, you must determine the indicator. That's the first stage. I will not explain anything on that. Go and get that material. That you get the material, watch the video, and that will do you well. Number two stage is once there is an indicator of an impairment, the next thing that you need to do, the next stage is you determine the carrying amount of the asset. Determine the carrying amount of the asset, that is the net value of the asset. And then, second stage should be to determine the recoverable value of the assets. Very, very important. Please let me stress that again. Number one, look at the first stage is for you to look out for the indicator, test for impairment on the asset. And before I move to that second stage, let me say this also, that it is very, very important for you to always look out for indicators of impairment of an asset. However, there are some assets, whether there is indicator of impairment or not, you must always test them for impairment. And a good example is your goodwill. Any goodwill that you have, you must test it for impairment every year. Every financial year, they must be tested for impairment. Number two is all the intangible assets. All of them, you must test them for impairment. And that is treated under IAS36. When we also look at IAS36, you have a good understanding of intangible assets. It's just as the name sounds, intangible. It means they cannot be seen, they can only be felt, you cannot touch them. That's the difference between tangible and intangible. Remember, we are looking at both tangible and non-tangible in under our assets in the statement of financial position. So we are currently dwelling on the tangible asset, the asset that we can see, the asset that we can touch. That's what we are dealing with now. The standard has deal with them. That's what we are dealing with. We have looked at IAS 16. We are looking at IAS 36. So we'll look at what is it called? IFRS 13, and then we proceed from there. So that is that for that. That is the first stage first. You must test for the indicators. And I said, whether there is indicator or not, some asset must be tested for. And these assets are categorized as a goodwill. That is what you get, the goodwill you get from business combination. That is when two or more company, when you acquire or you merge into companies and the last, the goodwill that you get there, there is always a goodwill in that combination, either a goodwill or what we call bargain for purchase consideration. When we're also looking at group account, you will understand that better. But once there's a goodwill, and then it has been established and stated in the financial position, you must test them for impairment every year, whether there is an indicator of impairment or not. That's number one. Number two, every of the intangible assets, you must test them for impairment, whether there is indicator or there is no indicator. Whereas other tangible assets, if there are no indicators of impairment, you necessarily do not need to test for their impairment. And then a good example of an indicator includes that of changes in technology, which has to do, that's categorized under the external indicators. I don't want to mention it. I want you people to study it. I want you to watch the video. I want you to get the materials and the like so that you can also understand it better up. So I want us to solve questions. That's why I'm trying to push forward. Uh, that's why I want us to push forward as much as we can. Go ahead. So that being said, please just give me 1 minute, please. 1 minute. Okay, so let's go ahead. All right. So, okay. So let's go ahead with the measurement. I just want you to see this step by step of measurement now. Under measurement now, we're going to discuss two categories of assets. We have the single assets and we have the cash generating unit asset. When we talk about single unit asset, they are assets that they individually generate cash flows into the entity. That is to say, they are being utilized, they are being used to generate cash flow independently. You understand? For instance, your motor vehicle, it's an independent asset in an entity. Property is an independent asset in an entity. You understand now? So we also have, that's what we call single entity. Then we also have what we call cash generating unit asset. I don't want noise. I don't want noise. Oh, sorry. So cash generating unit assets. Cash generating unit assets, they are assets that are combined in nature. They are together. They are mustered in nature, and they cannot stand alone. They cannot be independent in terms of how they generate cash flows into the entity. A good example is the bakery, for instance. In the bakery now, you have the oven, the heater, you have all manner inside the bakery, the cutter, all of those ones. All of those assets put together, you know, they are what will make us to generate cash flow into the entity. For instance, now, all of their items, assets in a bakery, they will only produce one thing. And what is that? They are going to produce, whether it is bread or whatever the flour is producing. Let's assume it's bread now. because we are used to bakery producing bread. So if it's only bread that they are producing, we know that the end product of every of those assets combined together is what? For them to produce bread. So that's why we call them cash generating unit. Now you cannot test them for impairment individually. All of them must be grouped together. Why can you not test them for impairment independently? The reason is that if you are to sell the bakery now, you are not going to sell bakery oven differently and sell the cutter differently or sell the eater differently. You are going to sell it as a component, as a group, as a mustard asset. That's what they call the cash generating unit asset. In other words, all of them together, when they are grouped, it is when they are going to generate what we call cash flows into the entity. So we have what we call the single assets, and we have what we call the cash generating unit asset, and their treatment differs. I mean, it's the same process, but their treatment differs. For instance, for the single asset, it's very, very easy. The first thing first is test for impairment. Once you note that there is an impairment or there's an indicator of impairment, just go ahead and test for impairment. And number two is you calculate the recoverable value. And I told you that is fair value less cost to say, and then value in use. Anyone that is higher in between the two becomes your recoverable value. And then number three is you compare the current amount with the recoverable value. If the current amount is now higher than the recoverable value, there is what we call an impairment. And how do you treat it under the single item and the single asset? That's why I said the treatment is different. Is the treatment that the process is the same, but the treatment is different. How do you treat impairment loss under single asset? Number one is you are just going to debit what we call your profit or loss account with the impairment value, debit it to your P&L, and then you credit the asset. You know that your asset will have a debit balance. I wanted to ask as a question, what kind of balance will your asset have? I've mentioned it will always have a debit balance. That is to say, the value of your asset will keep increasing as you are debiting it, and the value of your asset will keep decreasing as you are crediting it. Now that a loss in value simply means impairment, it means that when there is a loss in value, for you to reduce that asset to the current value, you have to credit it. And then, for every debit entry, there must be a corresponding credit entry. That is the basic rule of accounting or of financial recording. So that is for single asset. Any impairment that you see, you take it to your profit or loss account, and you debit the asset there. I mean, you debit your expense, and then you credit the asset. But for cash generating unit, it is different. The treatment is different. Like I said, the process is the same. For cash generating unit, the process is also you check for impairment, identify the asset and check for impairment. If there is any impairment indicator, please test for impairment. And then number two, calculate the recoverable amount, the value, using the value, fair value less cost to say, and then value in use, anyone that is higher, you choose it. And then you now compare the current amount with the recoverable value, and then if the current amount is higher than the recoverable value, there is an impairment. But the treatment is different. Under the cash generating unit asset, the treatment is as follows. Number one, if there is anything like goodwill there, that goodwill must be nil off from that impairment. That is number one. That is number one rule. Please take note of that. If there is any goodwill in the cash generating unit, in the composition of the asset that makes up the cash generating unit, that goodwill first must go. You nil it off. If the impairment amount is now still remaining, other assets will now, you now apportion the remaining impairment on a pro rata basis on the other asset that is remaining. I hope it is clear. Aregbe, you are raising your hand. Please, if you want to ask a question. Aregbe?
Yes, sir. I have a question, sir.
Please go ahead.
Yes, sir. Sir, you said we would debit impairment loss in the POL as expense and we credit the asset, are we doing the same for assets that are carried as revaluation model as well?
Okay. Well, let me answer your question directly. Now, you didn't allow me to land before you ask the question. So let me Kuma use your opportunity to
Okay.
also let me use the opportunity to also expand further. Now, for this single asset, you must always be careful to check if it is the first time that they are testing or that you are calculating for impairment. If it is first time that you are carrying out an impairment on an asset or that the asset is giving you an impairment, you must first of all, you should know that there is no revaluation surplus for that asset as at today. If it is the first time that the asset is being tested and then the asset is having what we call impairment. Now, the first that should come to your mind is this asset hasn't been revalued before. If this asset has been revalued before, it means that there should be what we call a revaluation surplus. If there is a revaluation surplus, what you just do is, if there is an impairment, you take the impairment to the revaluation surplus. That is to say, you are going to now, what is it called now? Credit the revaluation, debit the revaluation surplus, as it were. Credit the revaluation surplus, you're also going to still debit your P or L. It's as simple as that. Now, what I'm saying is this. It's very, very important for you to note when there is a revaluation surplus on any of the assets. If there is a revaluation surplus on the asset, please, and there is an impairment, you have to go and reduce that revaluation surplus by that amount. In other words, it means that you are going to credit assets and you are going to credit revaluation surplus, because revaluation surplus must be reduced by that value. Very, very, very important. Is that clear now, Regbe?
Yes, sir. It's clear, sir. Thank you, sir.
So please always look out for revaluation surplus. When there is revaluation surplus, deal with it first. Franca, you are raising your hand.
Yes, sir. Thank you, sir. Please, still based on this revaluation surplus, is it going to be included in a question for us to know that it's not a first time revaluation? How do we know if it has been revalued before?
Okay. Well, the certain thing is this. Your question will always give you the overview of how to answer or the kind of answer you are going to give. They must always tell you if there is a revaluation surplus before now. Very, very important. Take note of that. They will tell you. They must tell
Oh,
you. And if they are silent on it, does know that there is no revaluation surplus.
oh,
Also, they may give you statement of financial position and then statement of changes in equity. Please take note of that. They may give you statement of changes in equity. Just note that once you see that there is what we
yes, sir.
call revaluation gain in the statement of changes in equity, definitely under your statement of financial position under equity, there will be a revaluation reserve there or a general reserve in that place there. Once you see it there, and you test for an impairment and you see that there is a revaluation for that asset or there is a surplus in that asset or there is a balance in that zone of changes in equity, just know that once you test for an impairment as an impairment, you have to treat it from that OC high. Is that okay?
Yes, sir. Thank you so much.
All right. So let's quickly take a question. I want us to just do it together. I must pass icon PSC has just recruited you. Oh, wait, there are so many questions in this material already. So let's not waste much time. I'm sure you understand what I've explained so far. So let's just take a look at this car generating unit asset. I've explained it to you. I want us to look at this example. Hmm? I hope you can still see my screen.
Yes, sir, I can see it at my end.
Okay, thank you. So we have the following CGU group. Please remember what I call the CG. Okay, Olabisi Lawa, you are raising your hand. Go ahead.
Yes, thank you so much, sir. I want to advise that we practice with ICANN question. How about that, sir?
Yes. Well, when it comes to ICANN question, I believe that whatever question I'm giving to you is within the scope of ICANN. I've looked at all the questions, and if you have any ICANN question that is giving you challenge, just let me know. We deal with them. It's just because I'm lecturing. That's why I'm not part of people that suggest questions to ICANN. At least at my level, I should certainly I should know the question that should be sent to you, and whatever I'm solving in class, I make it as simple as it should be. And the reason is so that when you get the basics, there is nothing they will ask you that you won't be able to deal with. I know that the questions I'm always giving to you is very simple, and that's how it should be. So that when you get the exam, or no matter how they bring it, you can always maneuver it in your own language. Huh? Is that taking?
Yes, sir.
Thank you. So I'm coming then. Let me look for one. I can pass questions since you want us to look at it together. So these are past icon questions. You can see my screen. This is May 2019 question 1. You can see it. What is the main objective of IAS36? That's May 2019. And the answer is to ensure that an asset are carried as no more than their recoverable value, that is at their current value, which is the higher of value in use, less cost to say, value in use, and fair value, less cost to say, the higher of the two. The excess of the current amount will always amount to impairment loss. And this is ACCA question December 2020. List 4 external indicators of impairment. So it's not that I don't have all those past questions. They are meant for those who buy the materials, though. But let's look at a complex question. So I've actually looked at all the past icon questions and there is nothing. So let's just set our questions and then we move. Let me make it complex. Since you want complex accounts, past icon PSA has just recruited you as an accountant. And at your uh, first job on desk, you were given the following details. One, that an asset which currently has a net book value of 500,000 was seen to have been meted, what do they call it now? Was seen to have been greatly impaired due to changes in technology globally. 2. The cash flow for the next 5 years is put at 100,000 each year, and it has been it has a discount factor of 10%. The 3. The ready buyer for this kind of asset quotes 450,000 and a cost and a commission of 5,000 required. If the present value of the cash flow has been calculated to be 450,000. Determine the following. Determine A. Determine A. I hope you are following, please. The kind of impairment and the indicator.
Hello, sir. Can you share your screen so that we can see what you are typing?
I'm coming, please. Just hold on. I thought I was sharing it. Okay. Sorry, I'm sure you can see it now.
Yes, sir.
B. Impairment required. Determine the kind of impairment indicator. The treatment. Okay, so can I read now?
Yes, sir.
So I must pass ICANN PSA has just recruited you as an accountant, and at your first job desk, at your first job on your desk, at the first by now you should be able to give me answer. You were given the following details. And answer we currently has a net book value of 500,000 was seen to have been greatly impaired due to changes in technology globally. The cash flow for the next 5 years is put at 100,000 each year, and has a discount factor of 10%. The ready buyer for this kind of asset quote 450,000 and a commission of 5,000 naira required. If the present value of the cash flow has been calculated to be 450, determine the kind of impairment indicator, the treatment of the impairment, if any. Treatment of impairment, if any. So now let's answer this question together. Remember our rule is you raise your hand and then we'll deal with the question. So now what kind of indicator of impairment is this? Now what I want as an answer is you tell me the name of the type of indicator, and you tell me if it is external or an external indicator. All right, Shitu, let's hear you.
External, sir.
What is the type of indicator?
Hello.
You said?
I said external indicator, sir.
And I said
Due to technology change.
what kind of indicator is that?
The assets have suffered the impairment of 50,000.
Okay, thank you so much. I'm giving 1 mark for that. Okay, Chin Mao. So, hope I'm correct.
Technology.
Changes in technology. Thank you. That is the type of indicator. This is changes in technology, and it is categorized under external indicator. So, who can tell me the process by that we are going to use for this kind of treatment? What kind of asset is this one? Is it a single asset or a car generating unit asset? Ayomide, go ahead. Idris,
Yes, sir.
Ayomide.
It's a single asset.
It's a single asset. Thank you so much. Okay. So who can tell me what is the carrying amount of this asset?
So the carrying amount is 500,000.
Carrying amount 500,000. Do we all agree with her?
Yes, sir.
Yes.
So what is the recoverable value?
The fair value less to cost is
450.
445.
Okay, 445. So what is the value you use?
Thing use is 50.
450.
Value you use is what? 450.
450.
450.
Okay.
We've not calculated value used.
Because it's given for 5 years.
Sir,
Did you see the question?
the value
Did you see the question?
Is in the question the
379.07.
present value.
The present value.
Okay, what do we now use the 10% discount factor for?
They have already made the job simple for you now.
They
So
have
what do you
already
need
made
the
the job
10%
simple
for?
for you now. So what do you?
If
I
they are,
think we'll
if they have not
discount it for
if they
5
have not
years
discounted it
using the
now,
10%.
yes, is that taken? Is it clear enough? So what is our request? You are raising your hand. You want to ask a question?
So it's simple, sir.
Okay, this one is simple, Abby. Okay. So what is the accounting treatment? Anybody can help us?
Mute your mic.
What's the accounting treatment, please?
$50,000 and you credit the asset with 50,000 because that's the impairment loss.
Okay. Credit what? What are we credit?
You credit the assets with the impairment loss, which is 50,000, and you debit POL with 50,000 as expense, which is the same impairment loss.
Okay. Is it correct? You are not talking or
Yes, sir, it's correct.
okay, thank you so much.
Yes, it's correct.
So this one is very simple. So let's look at this question 2. An asset has a carrying amount of 36 million and the cash flows from the continuous use of that asset from the continuous use of the assets is as follows: 10 million each year for 4 years. The discount rate is 10%. What will be the value in use? Are we still together? Can anyone attempt? What do
Yes,
we
sir,
do
we are
now?
together.
Yes, we
Can anyone attempt? What do we do now?
will use an annuity formula to get value
It
always.
Good. So what is the annuity formula?
1 plus R
So I think
bracket
the
minus
value
N.
in use,
One.
the value in use is 31,698,000.
Hold on. 1 plus R. Go ahead.
In bracket power of minus N.
I'm coming. 1 plus R. That's just the power n, all right?
Yes.
This to power n or minus n.
Minus N.
Are you sure? Okay.
Yes.
We cannot correct that.
Why would you say she's not correct? Let her finish now. I want all of us to learn. That's why I'm making an open class and a very interactive class it should be. Okay, you can't say she's not correct. She's actually correct. It depends on how you want to put it. There are two ways to write it. Let me rewrite this now. You can as well say it is principal multiplied by, open bracket, 1 plus r raised to power n minus 1 divided by r. So this is an annuity formula. It's either you use the first one or you use the second one. P stands for principal, 1 stands for 1, R stands for rates, N stands for number of years, and this R also stands for rates. Now it's either you do it this way, 1 plus R raised to power minus N, or that is your all of this one that is in bracket divided by R. I'm trying to do the division. Well, let me just put it direct so it will just give us an issue. Divided by R. You know, using a computer as well, the thing is not working. But you understand what I'm saying? This 1 plus R raised to power minus N divided by R, or 1 plus R raised to power N minus 1 divided by R. Either way, it's your annuity formula. Huh? Is that clear enough?
Yeah.
Please, can you substitute all those figures inside? Let's go ahead. So we have our principal to be 36, no, to be 10 million. In fact, let's leave the P out first. It's the same thing, sure. 10 multiplied by 1 plus, what is our rate?
10%, 0.1.
That's 0.1 raised to power, how many years? 4 years. Which one are we choosing? Are we choosing this first formula minus N, or we are choosing the other one?
The first ones.
Okay, minus 4 divided by, what's the rate? 0.21, that's 10%. What will it give to us? First of all, you do the one inside bracket. Remember, BODMAS, bracket off. So do all the one in bracket first. What will it give to us? Please, are we still together?
Yes.
Is it difficult?
No.
What is the answer?
I don't know if another person could.
Mute your mic, please, Franca.
Me, I'm getting two different answers.
Are we still together, please? Michael, please go ahead.
58.3.
Huh?
58.3.
58.3.
58. 58.
68.3.
Yes.
Okay. Any other answer? Any other person? Blessing, go ahead.
So I'm getting 6.83.
Okay. All right.
I got 68.3.
I got 68.3.
All right. Thank
Are
you.
we multiplying by 100?
I got 6.83. 6.83.
6.83.
Yeah.
6.83.
Multiply by 10. What will it give to you?
Sir, I
Go
have
ahead.
a question,
Multiply
sir.
by 10. What will it give to you?
Sir, the number of years is 4 years.
Yes.
I think n is -1. Why are we still having minus raised to power -4? Since n is 4.
That I gave. There are two formulas here. We have P multiplied by 1
There are
plus
two
2.
formulas here. We have P multiplied by 1 plus 2.
Okay.
You can mute your mic now. So I won't be hearing myself.
I was looking at the
I
second
won't be hearing
formula.
myself.
So if you are using the second formula, there will be no
So if
minus
you are
n
using the
there.
second formula, there will be no minus n.
There will be no minus n if you are using the second formula. So what we just have is, instead of putting this, it should even be 1 minus 1 plus r raised to power n divided by r. I want everybody to attempt this, please. Are we still together?
Yes.
Yes, sir.
Yes, sir.
Together.
Yes, sir. Together.
So what do we have? Please go ahead. Tell me your answers.
68.3.
68.3. Okay. So what is the impairment now? If we are all agree as our answer, are we still together, please?
Yes, sir.
Is it difficult? Is it something that is difficult?
No, it's not difficult. It's just about getting the formula right.
Okay. Now, let's do, instead of, but it's better you practice and know this annuity because you don't have the time in your exams. We can as well do this thing one after the other by using, that's 1 plus r raised to power minus n. And we'll do it year by year. And then we'll, like that. We'll now do plus. Do it for first year, do it for second year. You can use this formula, we'll do it one after the other. So that will now be 10 multiplied by 1.1 raised to power. This one is, what is it called? The first year is 1. Anything raised to power 1 is what? Are we together? Are we together, please? We are just starting. No, don't be. This thing should not be difficult.
We are just starting. No,
Yes,
don't
sir.
be.
Yes,
This
sir.
thing
We
should
are
not be
together.
difficult now.
We are together, sir.
Me, I don't know where I
I
got
don't
my
know
own
where I
wrong that
got
I
my
don't
own
have
wrong that I don't have
decimal
point
point in my
in my answer.
answer. Everybody is having
Everybody is having
68.3,
68.
but my own is 66. So I don't know.
60 what? Your own is what, please?
68, 68301. No decimal.
It doesn't matter. Because some people were, in the process of calculation, it depends on what, if I use some calculator will give you to
Okay.
one decimal
Thank
place,
you.
one will give you 2, one will give you 3. You understand? Is that taken? So please, let's do this one after the other. Maybe it will help you to also understand it. But in your FM class, I'm sure you should be used to some of these things by
Yes,
now.
thank you.
So let's go ahead and do this thing one after the other. So what is 1.1 raised to power minus 1? That's the first year. Your first year annuity will be what? 0. For 10%, I think it's 0.909. Yeah, I think so. You have a calculator. Please press 1.1 raised to power minus 1 is what? Are we still together?
0.9090.
Well, multiply by 10. What will it give to you?
0.9090.
Thank you. Please take that down.
Yes, sir.
Second one.
Yes, sir. Yes, sir.
Yes, sir. Well,
0.
multiply by 10. What will it give to you?
9.0.
9 point.
9.0909.
Thank you. Please take that down. The second one.
Mute your mic, please. I'm begging you. So we can as well still do it like this. 10 multiplied by 1.1 raised to power minus 1 plus 10.1 raised to power minus 2 plus 10 multiplied by 1.1 raised to power minus 3 plus 10.1 raised to power minus 4. So we say our first here is what? 9.09, 9.09, I think so. 91. Okay. Plus, what is the year 2? 1.1 raised to power minus 2 is what?
0.8264.
0.8264.
Multiplied by 10 is what?
No, 8.28.
8.26.
8.26.
8.26. Okay. What was 1.1 raised to power minus 3?
0.75.
7.513.
0. Hello.
7.51.
0.751.
Multiplied by 10. What would you give to? I'm talking to the person that gave me 0.751.
7.513.
Oh, thank you. So 1.1 raised to power minus 4. What will it give to
So
you?
0.683.
6.38.
830.
6 point
6.683.
6 point.
6.83.
Okay, so
83.
add the 4 together. What will you have?
83.
0.6, not 6 point.
0.683 multiplied by 10. What will it give to you?
No, it has already been multiplied.
683.
That's why it is 6.83.
So now I'm talking to the person that gave me 0.8683 to multiply by 10.
Oh, okay.
So the total of the 4 together is what?
6.83.
6 point. Did you just say 6?
31.69.
9.
31 point.
Yeah,
31.69.
31.69.
That means your annuity, those that
That
use
means
this
your
annuity
annuity,
formula,
those that use this annuity formula,
your answer is not correct.
your
This is
answer
what
is
we're
not
supposed to have
correct.
at
Uh-huh.
This is what we're supposed to have.
Yes.
The total is 31,698,000.
698,000.
You know, you're supposed to subtract it from the 36 million.
So do your annuity again, please.
Annuity again, please.
Sir, I used the annuity formula and I got the same answer.
You got this 31.69.
Yes, sir.
Thank you so much. So that means for those that use annuity, this is what you are supposed to get. 31.69. So what we are doing now, this calculation that we are doing now, that is how to do your value in use calculation. We are determining the present value of the future cash flow of an asset. Do we understand now? So I know why I'm making it looking difficult for you now. So that when you don't know where I can will go and bring your question 1. And in the last video, I did not treat value in use like this. That's why I'm taking my time to do the video for the one I asked you to watch. That's why I'm taking my time now to do this value in use for you. For you to know that it's very, very simple. It's not something that is difficult. It's just for you to know how to determine the present value of the future cash flow of the asset. Is that taken? So please, if you cannot use the annuity formula, do it 1-1 the way I've done it now. And it's even good for you to also know how to use both the annuity and doing it 1-1. You may have a question that will give you different amount for each of the year, different cash flow for each of the year. This one now, they gave us 10 million for each of the 4 years. And also, they may give you first year 10 million, second year 8 million, third year 15 million, fourth year 20 million. So you can't use annuity for that. So you have to also use this 1-1-1 that we have done. That's why I'm trying to do the two example together. Is it clearer now?
Yes, sir.
Should we still take another example on this value in use, or we should just go ahead?
Another example, sir.
Okay.
Another example.
Okay. Um, so let's quickly look at this one together. The discount rate of for value. Sorry, please. The discount rate for a value in use is 12%, and the future cash flow of 2 years with a future cash flow future cash flow of 2 years. Cash flow year 1 is 100 million. Cash flow for the second year is 80 million. Determine the value in use. Can we quickly do that? I'm going to
All
call
right,
on
sir.
somebody to give me the formula for determining the present value of an asset. Who will I call? Enaps James. Enap James, are you there?
Yes, sir.
Oh yeah, give me what is the formula for finding the present value of an asset? Not annuity, not annuity formula.
One plus R raised to power minus N.
Thank you very much. I'm giving you 1 mark for that. Please claim it. Now
Thank you.
everybody determine the first year and the second year present value of this cash flow for me. The discount rate is 12%. What will be the future cash flow of the asset? Please, you have just 2 minutes. And once you are ready, just raise your hand.
So how do I claim a mark? Sorry.
Oh, you claiming it. Just be saying, thank you, Lord, though. You are looking for 49 to pass. I'm the one that dashed mark. Oh, go and ask the people that did it that are in professional now. That's how we were dashing them mark. They were claiming it and they all passed. So be claiming it.
Amen. I claim it. Amen. I claim it. Thank you, sir.
All right. Okay. Aregbe, go ahead. Or wait first. Don't answer. Wait. Let some other
Don't answer.
persons.
Wait. Let some other persons.
Let them also try. Any other person, raise your hand. Oh yeah, now somebody should bail us out. Okay, Idris Ayamide, go ahead.
Yes, sir. For the first year, which the cash flow is 100 million, so the present value is 89,285,714.
Okay. That's please keep that question, keep that answer by the side. Bukola Oyewole, go ahead. Give us what's the second year.
All right, sir. The second year, which the cash flow is 80 million. So the NPV is 63,760,000, sir.
That's I didn't say you should do MPV. It's PV. I asked you to do.
Okay,
Yeah,
the
Bukola.
PV, sorry.
Okay. Is what?
63,760.
Thank you. I'm
60.
giving you. Before I give the mark, let's do it together first. So let's go ahead and do it very quickly. So we have the first year to be the principal to be 100 multiplied by 1.12 raised to power minus 1. So 1.1 raised to power minus 1 is what? 1.12 raised to power minus 1 is what?
0.89.
So 0.89 multiplied by 100 will give us
0.8928.
8.928. 89.29.
anyone you write, whether 89.28 or 89, you are right. And so the second one is now 80 multiplied by 1.12 raised to power minus 2. So 1.1 raised to power minus 2 will give us what?
79.
0. What?
7971.
0.7971.
Multiplied by 80.
Multiply by 80.
0. 0.0.
63,768.
Okay.
3.78.
3.78.
3.78.
So that is how to determine
So that is how to determine
the present value of
the
a
present
cash
value of a cash flow.
flow. So if we are, please mute your mic.
Please mute your mic.
So now in this question, your value in use will now be 89.29 plus 63.78. Is that okay? Now in this question, they did not give us the current amount of an asset, so we are not determining the impairment as it were. Is that okay? So I'm sure we are okay now. We can bring down our hands. Now let's really look at a question under. Please bring down your hands. So let's look at the question under cash generating units. Very, very important for us to know how to do the cash generating unit asset. So let's look at this question. An asset of cash generating units that has a current amount of 60 million, and included in that is goodwill of 10 million, recovery value of 55 million. How will the loss be allocated? Remember, I told you under the cash generating unit, the process is the same. First, you test for the indicators, and second, you calculate recoverable value, and then third, you compare the recovery value with the carrying amount. If the recovery value is not less than the carrying amount, there is an impairment. In other words, the carrying amount is higher than the recoverable value, and there is an impairment. So, once you see that there is an impairment, the first thing that I said, once there is goodwill there, the whole of the goodwill will be nil off. And then if there is any amount that is now remaining, you prorate it on the other assets that are remaining. Is that taken? So let's look at this question together. An asset that has a carrying amount of 60 million, but included in that CGU is 10 million. In other words, in the carrying amount of this asset, goodwill is 10 million. But we are given that the recovery value is 55 million. Now, by the process that I've given to you now, what is there any impairment? If there is, what is the value of the impairment?
That's 5 million.
5 million.
5 million is the impairment. In other words, the recoverable value is higher than, the carrying amount is higher than the recoverable value. The recoverable value is lesser than the carrying amount. Do we all agree?
Yes, sir.
This is the only way that I will teach you that you will not forget. Don't look at ICANN as something that is difficult. I know what I'm saying. This is the way that we will pass what we did. Make things very simple. And when you see the question, you can attack it anyway, anyhow. Is that clear? Now, we have been able to determine the impairment to be 5 million. What is the next thing to do? The next thing to do is to, first of all, nil off the impairment from the goodwill. We were told in this question that the goodwill is how much? 10 million. And we have 5 million impairment. It means that, first of all, we are going to take that 5 million to the goodwill, the 5 million impairment to the goodwill. So it means that at the end of the day, there is nothing that we are going to prorate to other assets with this question. Very simple. I want to believe. Do we understand it now?
Yes.
Thank you. Now, let's proceed and look at, let's expand this question. Let's assume that this asset has a current amount of 100 million. Okay, sorry, please. Current amount of 100 million. And then the goodwill inside this 100 million still is goodwill of 10 million. And then recoverable value is 85. Declare the CGU the following assets are the following assets. Goodwill is 10 million. Plants is 50 million, and plant is 50 million. Motor vehicle MV. Motor vehicle is 10 million, and inventory is 30 million. The recovery value is 85 million. Determine the accounting treatment of this item. Can anybody try? Or I should just do it? Are we still together?
Let's try.
Yes, we're
Let's do it
together.
together.
Oh, yeah,
Let's do it
try.
together.
Let's try, sir. Let's
Yeah,
try.
try.
Let's try it.
Okay.
Let's try it.
So I'm waiting for you. You have just 2 minutes. Give me answer. Just hold on, hold on. Hold on, just hold on. Okay, Thomas Bode, you raise your hand. Go ahead.
So can I?
I can't hear you. I can't hear you. Yes, you can go ahead, please.
Then the breakdown gave us that plant there is 50 million. The motor vehicle is 10 million.
while inventory is 30 million. And you told us that impairment is not applicable to inventory. So out of the 100 million, we have to remove 10 million from it. So if we remove, we are going to have 60 million since if we add up motor vehicle, 10 million plus plants, 50 million, it will give us 60 million. If we remove the recoverable amount of 55 million, we will now have 5 million as impairment. Then if we remove it from goodwill, there won't be any amount to be allocated.
All right. Thank you so much, Emmanuel. You have tried, and that your opinion is very, very. How will I put it now? It's okay, Sha. It's to your understanding. That's better. I know why I actually had to put inventory in this question. Please mute your mic. I know I had to put inventory in this question. And thank you because you were brought up to speed. Inventory impairment is not to be tested on inventory. I mentioned some other assets. Inventory, financial assets, you don't test them for impairment. Please take note of that. They can use it to confuse you in your question, and that's what I just did now. Huh? Very, very easy a question this is. But if you are confused, you are going to just miss everything. Everything. So let's do it together. Since you have attempted, then you now mark yourself if you have done the correct thing. Okay, Michael, you are raising your hand. You want to ask a question. Idris, just put down your hands. Put down your hands. You mark yourself and
Yes,
see. Go ahead.
I'm confused. I'm confused on what the man said.
That's why I said just hold on. Let's solve it together, and then you will know whether the man is correct or you are correct. Okay. Now, what is the first step? The first thing first is for us to, determine the carrying amount. I mean the impairment if there is earnings, and also that's the first process. Can we still remember that? So the first thing first is determination of impairment.
Yeah.
And then our carrying amount is what? Carrying amount is equals to, where is it? 100 million. And then the recoverable value equals to what?
85 million.
85
So there is an impairment of what?
15 million.
Impairment equals to 15.
million.
Yes. Let me put M on top like this. So we have M N in Naira. So our impairment is 15 million. And I told you once you have your impairment sorted, all other things being equal, the next step is for you to determine how you are going to operate. Is that also? So the next thing is for us to allocate this impairment because it is a cash generating unit asset. Is that also? So how do we allocate? The first thing first is, so second allocation of impairment. So first to goodwill, Our total goodwill equals to what? 10 million. Therefore, we need of deduct the 10 million from the 15 million. Deduct the total 10 million from the 15. So we have 5 million as our impairment balance. Is that not so? So thirdly, we prorate the 5 million remaining to other tangible assets. How do we prorate now? Now, you are not going to consider inventory of 30 million. The other tangible asset that we have remaining is plant and motor vehicle. So the first thing to do is to find the total of the tangible assets. Find the total of the tangible asset. Are we still together? Plant Please, if you can hear me, just give me a thumbs up. So plant is where is the question? Plant is 50 million, and the motor vehicle is 10 million. The total is now.
We can't see your screen. Oh.
Sorry, apologies, please. Please, can you hear me? Just confirm if you can hear me.
We can hear you.
Okay. Hold on 1 minute, please. So, thank you. You can hear me now. Total is now 60 million. So on a pro rata basis, we are going to now, since we are operating for plant, the share of impairment for plant will now be equals to 50 divided by 60 multiplied by 5. Then the share of motor vehicle will now be equals to 10 divided by 60 multiplied by 5. And that will be equals to what, please? Do your calculation. What do you have? For that of plant, we have, which is together, 4.167. 4.167 And then the other one, which is motor vehicle, is 0.833. The total should give us 5. So that is how to operate. So like I said, you are not going to consider inventory or financial instrument anytime you are considering or you are doing cash generating unit assets. Anytime you are treating it, you won't consider it. So that's that for that. I'm sure there are no questions that will be more than this. This is also how to deal with this kind of impairment under IAS36. So that being said, I think that will bring us to the end of the class. I want to thank you sincerely. Like I've said, please, if you have any questions, just reach out to me on the platform. I will attend to you. Chat me up. I will attend to you anytime, any day. Thank you so much for your time. You have a very lovely